Yeah, well, I'll tell you a couple things. First of all, I think that the TSX 60 actually might be kind of a black sheep out here that could be a dark horse. I like the Canadian dollar right here. If you look at the Canadian dollar, point 0.68 against the U.S. dollar here at the most recent lows. First of all, it has a beautiful, beautiful long-term technical bottoming pattern. And when you got down there, this is at the height of the political mess and the political meltdown that you had, north of the
Yes.
border from here, right? Not only that, but of course the trade wars and all the back and forth. And it's like, look, we are each other's best friends. We need to be working together. And to whatever extent, you have the polarization of the political views now at the leadership level being the real problem. I don't think the average person, I love Canada and Canadians. You know that, Mike. I mean, I love it up there. So, and I think most Canadians would say they love Americans. So it's kind of ridiculous, this whole thing to begin with. All right. But having said that, when you were below 70, you had the worst news priced in. I don't think the tariffs are going to be what they said they were going to be and going to last long if they even come to fruition. All right. The political situation may not be ideal up north, but at least if it gets kind of stabilized, you are so cheap relative to the commodity indexes and relative to crude oil on a thing that's normally very positively correlated. You could see 80 cents easy just to snap back to where the Canadian dollar might be if things kind of normalize.
Well, it's always terrific to get a chance to talk with Greg Weldon. I've always referred to him as the analyst other analysts read. Why? Because, first of all, the global perspective, the depth of the analysis. And so, first of all, Greg, thank you for joining us here. But I sort of smile now because when you, of course, have been doing analytical work for decades, but when you first started and you would start talking about geopolitical, what's happening in another country, people go, why are you doing that? At least it's obvious now with the Trump tariffs. Nobody can miss that what happens in one country impacts others, which you need that global perspective to drill down to it. Let me just start with gold, because you are the gold trading boot camp guy. You've been on gold for decades. We've had the big run up. Can you give me your perspective on it now?
Yeah, well, it's interesting when you talk about the geopolitical situation and how much more important it has become to be not so U.S. centric in your perspective. Really ties into gold because it's been a Chinese accumulation deal. It's been central bank accumulation. It's been record amounts. It's been around the world. It's been linked to the thought that a BRICS, unit will still be something in the future that will become a reality. I think the Trump tariffs, serve an unintended consequence of pushing people towards that, of pushing people away from the dollar, of where you see dollar down, stocks down, bonds down big in a single day. And, it's foreign selling of U.S. assets. So, when you tie all of that together, this is a bigger picture geopolitical situation, as I've been talking about for several years now, really dating back. And we had this conversation even at the time in 2018, when China opened a crude oil futures contract priced in renminbi, trading the Dubai OPEC grade, got Russia to benchmark their Urals crude to it. And that was the beginning of the end for the dollar, my consideration. When you talk about being less U.S. centric and you talk about trade, I mean, let's not forget, China is 3-2 now, larger every single month in terms of imports and exports, in terms of being the largest trader in the world versus the U.S. So what you're also doing is pushing a lot of these countries more towards China. And I have been talking about a dynamic where we're in a global world war to begin with over commodities and resources, food and energy, pretty simple. You can go to when China held the Olympics and Putin met with Xi and Biden decided not to go. And what was the end result? A 30 trillion Chinese state bank loan to Russia to build the new pipelines from Siberia to China for oil and to engage Kazakhstan for natural gas shipments. Then they invade the Ukraine. What's there? What's the breadbasket, right, of the former Soviet Union? It's food. They have the Crimea. They took a couple ports on the southern, tip of the Ukraine. All of a sudden, they have a means to ship food to who? To China. You have OPEC, Russia, China, that side of the world. And it's a new axis of power over there that has a significantly more power than anything the U.S. has ever, faced off against. I hate to use conflicting type terms like that. We shouldn't always be in conflict here, but that's where we're at. That's the reality of the Donald Trump presidency. And to the degree that, that also just pushes them, you have Japan and China talking. That's really mind blowing when you think about the history. So you have Vietnam in play because of gas drilling rights, and China has been pushing their man-made islands out further and further to try and gain international waters at the expense of Vietnam, at the expense of the Philippines. Taiwan's in play, Korea's in play, and all of a sudden now you have Vietnam talking they're going to build a canal with China money. And so when I look at all of that, this story in gold so far has been Chinese accumulation, central bank accumulation for what's coming next in terms of de-dollarization. And then when you think about de-dollarization, then you see the price move in dollars. And I think that we've had our first wave, maybe a correction coming, maybe not. But I think the odds have increased a little bit. You might see a correction here. But the longer term is you haven't even seen the beginning of flow of U.S. investor money into the precious metal sector, particularly the mining shares.
And again, people make a distinction: are they traders, are they investors? But I'm hearing loud and clear as an investor. It's been, of course, and thanks also to your participation in this, but it's been a core principle of Money Talks, maybe the principle, to protect yourself by having a core position, a growth position too, and then for traders, maybe a speculative position, or that you're going back and forth. But you've got to have a chunk of money in gold, and I think that's obviously proven to be very good advice. But what you're describing is the dynamics behind that move haven't changed. They're still in play.
They've only intensified. I mean, all the reasons to own gold have only intensified, throughout this, really the period going back to, frankly, 2018. And let's not forget what else happened in 2018. It was Jerome Powell took over the Fed chair, and the first thing they did was publish 11 different white papers, so over 310 pages, and basically laid out the new policy paradigm, which they've carried out, which basically said we're willing to accept higher inflation because we need to maintain growth because of all the debt. And this is one of the biggest things that's changed. You've had this 40-year downtrend in inflation and interest rates going back to when Volcker defeated inflation. But, Reaganomics was different, and the Reagan Revolution was different. It's not the same now. They had no debt, and they outspent Russia. They used the fiscal side. We don't have that power right now. So it makes it a lot more difficult going forward, which means more of the emphasis is on monetary policy. And we know the limits of interest rates. We've seen the European complete debacle, failure, and folly that was negative interest rates. So what's left? QE. And at the beginning of the year, there were a couple of themes I put out, my outlook for this year. One of them was the macro event horizon. And we've talked about this, me and you, Mike, personally, about how a black hole works. And the event horizon is the line where you've crossed into the black hole. You don't realize it yet. The gravitational pull's not ripping you apart yet, but you are in this gravitational force that you can't escape. You can't get out. You're in and you can't get out. And I could really simplify things, even though it's so much more complex, but it's really simple and glaringly plain to note when you see public debt and household debt now around $56 trillion between the two, which is basically all we the people debt here in the U.S., against GDP, and it's 186 to 1. You're talking about I need to create $1.86 of new credit to create $1 in new GDP growth, and I need the growth to service the debt. That's the cycle. You're in the black hole. And as much money as you will print to use as your fuel to try and use propulsion to get out of the black hole, it's not going to be enough. And it'll be an ongoing process now. And that's what really makes gold longer term. In kind of the vein that we talked about almost in fantasy land 10 years ago, we're living in fantasy land now from that perspective as a gold person.
Such a great point, though, because this is not part of the public discussion. I mean, occasionally you get forays in to look at the size of Canadian sovereign debt, but in this case, U.S. sovereign debt, the buildup. Now, I just can't believe that it's not even mentioned, though. We have an election going on in Canada right now, as you know. Yeah. Oh, no, I mean, it's not even mentioned. And yet the challenges and the potential to really impact our personal lives is just massive.
Yeah, it is. And, it's already impacting our personal lives because not only is it a, debt black hole from the perspective of, public debt, household debt against GDP and that dynamic and, sovereign debt, but it's also from the consumer perspective. Why? Because right now you've just seen for the first time ever that the personal spending is higher than personal disposable income on a month-to-month basis. Not only that, credit card debt is greater than personal savings. For the first time ever. You've crossed over, it's like you have several debt black holes that are, begging for your attention here that are pulling apart. When you talk about the consumer, I mean, you could say that real retail sales, because retail sales don't account for price changes. have been in deflation for 18 months. You look at something like the Richmond Fed, the ISM numbers, but the Richmond Fed just came out, service and manufacturing for the last 3 years, 30 months or more in each of those indicators has been negative. You have been in this kind of rolling recession. It doesn't seem like a recession because the stock market wasn't reacting like it was a recession. The bond market wasn't reacting like it was a recession. But for the consumer, one of the other themes for this year going out forward, and that I wrote in January, was a hardening consumer cocoon. And when you talk about where, you have the employment numbers came out. Now, the labor market, to me, has already rolled over. All right. I could rip it apart, but I won't take that time. It's not as important to note, other than to say it's not as good as everyone says it is. But the way it impacts the consumer is that average weekly take-home pay is now increasing at a 3.2% rate. That's down 100 basis points in the last 5 months. Where you have inflation PCE core is 2.8, which means real income's only 0.4. Here's where it gets interesting, because online retail sales has been the strength since 2009, since 2020. It has led the way all the way until the last 6 months. Beginning in September of last year, online retail sales are up 0.14, less than 0.2% over a 6-month period, which means it's what? 0.4 on an annualized basis, the same exact level where real income is. All right. Now, that's a coincidence, but it's a really interesting coincidence, because when you talk about a consumer cocoon, when you talk about credit card debt at the highest level ever, borrowed at the highest interest rates ever, and now the delinquency rates are at 2008 pre-financial crisis levels, it's a telltale sign that consumer going forward is going to be struggling to expand spending. And not only that, one last thing, make a long answer a little bit shorter. The New York Fed survey just came out. It's a monthly survey of consumers, and it shows a couple of things. Number one, consumers expect their income to be the lowest in non-pandemic in 15 years, all right? 2.8% year-over-year growth. When you look at their dispersion index, which gives you a range of where people answer, okay? The bottom end of the dispersion range is minus 1.7. There are a lot of people out there that expect their income over the next 12 months to actually decline, deflate, actual deflation. And when you match that against inflation, you're talking about 5-6% real income depreciation. And then you wonder why the percentage of people saying they expect to be financially worse off in 12 months is skyrocketing over the last 6 months. All of this ties in for the last 6 months in the first quarter of this year to put the consumer in a very difficult position going forward, which plays back at the Fed, who will have to make a choice in their mandates, and they will choose to acquiesce to higher inflation to protect the consumer and to protect growth because they have to.
And back then to also tax revenues, if the consumer is in that position, tax revenues down. And that brings us back to supporting the massive increase, continual increase in U.S. sovereign debt, which has global implications. It's not a surprise. They are all related, but very significant numbers, with that. Great. Let me come back to the stock market for a moment, though. It's a relative game. It's where else will the money go is one of the questions. And I'm just wondering, with geopolitical tensions in Europe, will money continue to come out of there? Shorter term, I guess, if that escalates, if the Russia situation escalates.
Yeah, well, I'll tell you a couple things. First of all, I think that the TSX 60 actually might be kind of a black sheep out here that could be a dark horse. I like the Canadian dollar right here. If you look at the Canadian dollar, 0.68 against the US dollar here at the most recent lows, first of all, it has a beautiful long-term technical bottoming pattern. And when you got down there, this is at the height of the political mess and the political meltdown that you had, north of the border from here, right? Not only that, but of course the trade wars and all the back and forth. And it's like, look, we are each other's best friends. We need to be working together. And to whatever extent, you have the polarization of the political views now at the leadership level being the real problem. I don't think the average person, I love Canada and Canadians. You know that, Mike. I love it up there. So, and I think most Canadians would say they love Americans. So it's kind of ridiculous, this whole thing to begin with. All right. But having said that, when you were below 70, you had the worst news priced in. I don't think the tariffs are going to be what they said they were going to be and going to last long if they even come to fruition. All right. The political situation may not be ideal up north, but at least if it gets kind of stabilized, you are so cheap relative to the commodity indexes and relative to crude oil on a thing that's normally very positively correlated. You could see 80 cents easy just to snap back to where the Canadian dollar might be if things kind of normalize. So I think that's interesting. Point number one. The TSX 60 is breaking out against the S&P, and I'm talking long-term, 15-year downtrend line with all kinds of bullish divergence down here. So I'm not so soured on Canada as I might be, but like you say, it's a relative play. We could all go down together. So it doesn't necessarily make it an outright buy. But what I do believe is going through this next phase when the Fed does come in and the dollar does come down and stocks do rally, because they will. And that's the highest correlation of anything. Lower dollar, higher stocks, all right? To the degree that you will see average Wall Street wealth managers, family office people, the general kind of public in the investing world, what I call the Wall Street money, that's been indexed, passively invested, or Mag 7, or whatever, it's been in. It hasn't been in precious metals. It hasn't been in the mining shares. Think about the mining shares with gold at 3,000. They're printing money every day, all right? And their input costs, mainly energy, kind of stable at low levels, right? This is like nirvana from that perspective. And just now the mining shares are not only breaking out, they're actually now, the GDX is up by over 2% against gold in the last 52 weeks. And if you look at the GDX against like the XLK, the Infotech, you look at it against the NASDAQ itself, it's up anywhere between 35 and 60% against these stock indexes. And you don't have these huge moves in Newmont, in the big cap blue chip behemoths that the Wall Street crowd will buy. They'll buy the names they know. So I think the next thing is something we used to, again, talk about in Fantasyland. I remember sitting around with my buddy John Fallon. I don't know if you remember that name, but he used to run the Prudential Bullion Desk. He went to Colgate where I went, so I knew him for a long time. In the early 90s, you had the whole Gulf War, and then gold started to perk up. And we used to sit around and say, man, if you get just a 5% allocation of Wall Street money into gold, it will explode. It's not deep enough to handle it. Now, I will say also that the most recent move, all right, in gold and this GDX, you've had the outperformance of the Canadian shares versus the GDX. They've been the ones leading. They've been the ones breaking out. Kinross, Alamos, Torex, there's a whole bunch of names. I just did a special. Any of your people want to get it, they can email me just literally last week on this too. But it's been owning the Canadians with the Canadian dollar hedged. And we've had that. That's been a beautiful play. But I think the next wave is a shift more into the dollar big cap blue chips that will drive the next phase almost backwards, kind of the smaller, I wouldn't call them juniors, but the smaller Canadian shares led this way as opposed to the big cap blue chips who normally led the way, and then the juniors would pull up and then outperform. Well, they've already kind of been outperforming, and now I think the U.S. stock market could see a rotation into the mining shares, which could be really explosive. Let alone that we haven't even talked about silver or silver mining shares.
Well, you know what? Seriously, I was just thinking time's short, and I've got to ask you about silver. But let me come back just, for the special report you did. We'll put that up on all our social media, in our email blasts, etc. So I think you're going to find a lot of people want to take advantage of that. And
let me just add real quick. Today we did a special on what if gold does correct from here, and I put out all the support points and all the buy zones for where it's old if you missed the move or you've sold it and looking to buy it cheaper, where you might look to do that.
Good stuff. Okay, let's finish with silver.
Sure. Yeah, it's been frustrating, but I think if you see, central banks are not buying silver. They're buying gold. All right. Silver is not going to be part of the asset that is backing the BRICS currencies. All right. So from that perspective, that's why it's underperformed. And what silver needs is the dollar to break. And it just did. And silver's now showing signs that it is perking up. And I'll tell you, I see the dollar just broke par 60, 99.45, these real key levels that long term, this has been an ABC multi-year correction in the dollar, Fibonacci base going all the way back to the 1981 high, to the 2008 low, to the recent high that we saw during the pandemic. And now it's breaking down. It has 10% of almost immediate downside at risk here. And I think maybe it pops just as we get the tariffs kind of roll off. But once the smoke clears, it'll be the consumer, it'll be the Fed, and it'll be the dollar lower. And I think that will be the boon for silver that we're waiting for. And silver, silver there's no problem getting to $50. And it's like when the dollar does crack and has people convinced that it is cracking for real, which I think it's happening right now. It's not a question of do you get to $50. It's a question of how quickly do you get to $50. And some of the silver mining shares are dramatically undervalued relative to the entire sector.
Well, just another reason to go to weldononline.com, weldononline.com. Follow Greg on Twitter also. And Greg, let me just say, and by the way, as I say, I'll put that stuff on social media for us so people didn't have to memorize. But I'll just say what a pleasure it is to get a chance to chat again. I do appreciate it.
Oh, my pleasure, Michael. You guys do a great job. I'm always happy to contribute. And I did another piece actually 2 days ago in Canada, all about the Canadian dollar. So happy to send that out as well. It's, I think I get asked a lot by your people. Most question after gold is, what about the Canadian dollar? So
I would
like
bet.
it here.
Great stuff, Greg. Thank you.
Yeah, my pleasure.